All right, welcome back. It's time for the Blaster strategy. So in the previous segment, we ran the Blaster screen and we found a stock that we liked. Now we need to zoom in on that stock's pullback to create an entry and a stop. Now, the previous day's high was $21.94. Multiply the high by 1.005 and you'll have your entry point. In this case, that comes out to 22.05. So the next day we have an entry point of 22.05 for that stock. Where does the stop go? Simply take the previous day's low, which was 21.48, multiply the low of the day by 0.995, and now you've got the location of the stop. In this case, the stop is going to be 21.37. So really, you've got your entry and you've got your stop. You don't have an exit yet, but don't worry, I'll get to that in just a moment. Now, by using the previous calculation, what have we done? We've placed an entry just above the previous day's high, and we've placed a stop just below the previous day's low. Especially for the entry, we're only going to use day orders, and if the order does not execute during regular market hours, allow the orders to expire, and then run the scan again after the close. Maybe the same stock will appear on the scan again, maybe it won't. Now, the order type is OCO/OSO. If you don't understand what that means, you need to go back right now to the order entry segment from earlier in the presentation and understand, because that's very important that we use OCO and OSO orders. Now remember, if this seems complicated, don't worry. We are going to cover this extensively in the mentoring program. In this case, we have a single order to go long and stop only. There is no exit, and you'll see why in just a minute. So here we have it on the screen. You can see there's a stop limit order to get into the trade and a stop market order to get out if it goes against us. Why did we do it that way? We want the stop limit for entry because we are going to eliminate the possibility of paying more than 22.05 to get into the stock. We might miss the trade, but we're not going to get burned on the entry by overpaying. And like we said earlier, if you miss the trade, it's not a big deal. You might be missing out on a trade that didn't even work out. Don't worry about missing trades. On the other hand, we're using a stop market order for the exit. Because if we're in this trade and it goes against us, we have to know that we're going to get filled. Even if the price is not certain, at least we know that we're not going to hold this thing as it goes down. So using a stop market for the exit assures us that we're not going to end up stuck in a bad trade. Now here you can see the next day's candle. The price actually gaps up and opens a little bit higher than our entry point. Then it comes down and fills our order. So we have our entry exactly where we wanted it. We have our stop now, which was contingent upon the entry, is now activated. All we really need to do now is manage the trade. So if the stop is hit during the first day, well, the trade's over. But let's assume that doesn't happen. After the market close, multiply the low of the day by 0.995. In this case, the low of the day was 21.95. We multiply that by 0.995, we get 21.84. Now, because 21.84 is higher than the previous stop of 21.37, we can move it up. We move the stop up to 21.84. What have we just done? We've just reduced the risk on the trade from 68 cents per share down to 21 cents per share. And you can see the stop has now been moved higher. This is called tightening the stop. We always tighten and we never loosen a stop. It is acceptable to raise a stop if you're long. That's called tightening a stop. it is not acceptable to lower the stop if you are long. Okay? And conversely, when you're short, when you're in a short position, you can only lower the stop, you can never raise it. So we can only tighten the stop, we can never loosen it. So if you're long and the low of the day times 0.995 results in a lower number than the previous day, I do not want you to lower the stop. Keep it right where it is. We never lower the stop if we're long. Now, we're going to continue trailing that stop until it is hit. So every day after the market close, you recalculate the stop every day. If you're allowed to raise the stop according to what I just told you, then we raise it. If not, then we keep it where it is. Now, I know it's going to happen. You're going to enter a trade and you're going to be making some money and you're going to want to just get out of the trade and say, well, I just want to ring the register. Okay, fine. You can do that. But I only want you to take a partial profit. Maybe close half of the trade, right? And hang on to the other half and keep trailing the stop in the manner that I described on the second half of the trade. What you're going to find here is that that trend might go on for longer than we assumed. It's also much easier to stay in the trade once we've taken a partial profit. I do not want you to hold these positions into earnings. It's very easy to determine the earnings date of a stock. All you do, just do a quick online search. There are many, many websites that list this information. Find out when your company reports earnings. Close the trade before the earnings report comes out, because that is a very dangerous event. And by doing that, we're avoiding what I call event risk.